Thank you so much. We welcome you all to a discussion on Axis Bank's financial results for the second quarter of financial year 2020. I will start with some views on the prevailing macro environment. There are various challenges at play in the macro today. Slowing economy, NBFCs and HFCs grappling with funding issues, leverage issues faced by certain promoters, certain other promoters under the lens of enforcement agencies, etc. All these create significant uncertainties for the banking business. If left unsettled, these factors will eventually have a bearing on stress seen in lending pool of banks. Adding to this, recovery and resolution in stress accounts has not seen material progress. Large IBC cases have remained unresolved for a considerable time, delaying the much-anticipated recovery cycle. Early news on pre-festival sales is also mixed. But the context is not all gloomy. To deal with the challenging economic environment, both the government and RBI are taking bold, aggressive steps. The RBI has maintained the accommodative stance, cut policy rates consistently, and judging by the comments of the Monetary Policy Committee, is prepared for further rate cuts too, especially given benign inflation levels. The government, on its part, has taken strong policy measures in the last 2 months, lifting sentiment. Liquidity in the system is adequate, and monsoon trends have been favorable. In this context, let me now offer a brief synopsis of Axis Bank's Q2 results. Our operating performance in the quarter has been strong. We have seen strengthening of NIM, controlled OPEX, healthy business growth, reasonably steady asset quality matrix, and a decline in stressed corporate loan pool. We have continued to focus on what is in our control, strengthening our balance sheet, and improving provision coverage. Overall, we remain firmly on track as far as our strategy is concerned, as evidenced by almost all the operating metrics. Having said all that, we recognize that we need to improve in a couple of areas. The bank slippage numbers have remained elevated this quarter, reflecting the situation in corporate lending I spoke about earlier. Almost all of our corporate slippages came from previously disclosed BB and below-rated clients. We have a residual stock of stress built up over the years. While slippages continue to come from this stock, the current macro environment is not enabling a quicker rundown of the pool. To that extent, we expect slippages from this stock to remain elevated. The good news is there are also some examples where slippages from this book are likely to be recovered in the next quarter. In our business segments, we are seeing some signs of positive sentiment returning in consumer segments. In car loans and home loans, the number of credit applications are increasing on a sequential month-on-month basis. Structurally, we continue to see huge opportunities in Indian retail banking. Consumer debt levels have gone up marginally in recent years, but remain significantly below developing country averages in almost every product category. Axis Bank's market share in these businesses has increased significantly in recent years, but is still not very large. So the opportunity and the desire on our part to grow this business remains strong. Our focus on retail customer has also led to sustained growth in our granular deposit franchise through our CASA plus RTD strategy. The bank had strong deposit growth during the quarter at 22%. Despite this strong deposit growth, CASA is another area where we need to do better. We need to improve our CASA growth going forward, and our teams are working hard towards that goal. During the quarter, we opened 190 branches, our highest in the last 24 quarters, to take the bank's overall domestic branch network to 4284. Branch banking continues to be an integral part of our growth strategy. Despite these investments in extending physical branch network, we have been able to keep OPEX growth under control at 6% year-on-year. In the small business and MSME segment, there are some signs of stress in terms of delayed payments. We need to remain cautious as the funding issue in NBFCs could have a bearing on this segment too. The bank's risk performance in this segment remains steady, but we are watching things closely for any adverse development. Given some of these conditions, the bank is also being cautious about the growth opportunity in SME right now. Our subsidiaries continue to deliver strong operational performance. In a very challenging environment for NBFCs, Axis Finance continues to thrive and has delivered strong returns with stable asset quality. Axis AMC has been gaining incremental market share with several of its funds among the top performing ones in their respective categories. Axis Capital continues to be a leader in equity capital markets, having executed some of the marquee transactions during the quarter. During the quarter, the bank raised 12,500 crores of capital through a QIP issue. We understand that this was the largest ever QIP by a private sector issuer. Successful closure of capital raising in the current tough market conditions is a strong indicator of investors' willingness to partner with Axis Bank in the country's long-term growth journey. Axis Bank is now in a position of great strength with capital and most of the senior management team additions in place. With most of the asset quality issues behind us and strong competitive position in the current environment, we remain committed to delivering on our GPS strategy. We continue to invest in our conservative stance on provisioning, compliance, and risk. We have a lot more to do on improving and automating our systems, controls, and processes. It's a gradual process. It will take time, but we are working at it and improving every day. With that, let me hand over to Jairam to take you through the bank's financial performance in detail.
Thank you, Amitabh. Ladies and gentlemen, good evening. It's my pleasure to take you through the detailed financial performance of the bank during the second quarter of FY20. As always, do keep the investor presentation handy as we expect to refer to multiple slides here. Let me start with a summary of our quarter. There are 5 themes that summarize our second quarter performance. Number 1, asset quality metrics largely stable with a decline in BB pool. Number 2, strong operating profit margins. Number 3, healthy growth metrics across both advances and deposits. Number 4, continued leadership across digital products. And finally, number 5, much stronger capital position in the wake of our recent capital raise. Over the next few minutes, allow me to walk through the details of these themes. Towards the end, we will also share the management's emerging outlook for the rest of the year. Let me start with theme number 1, asset quality. Please refer to the asset quality section, starting slide 47 in the earnings presentation. NPA ratios for the bank improved during the quarter. We ended the second quarter with a GNPA ratio of 5.03% and a net NPA ratio of 1.99%, both lower than corresponding numbers at the end of June. Gross NPA at the bank level was 29,071 crores at the end of the second quarter. The GNPA book has now reduced in absolute terms for 6 consecutive quarters. Net NPA of the bank was at 11,138 crores. Gross slippages in the quarter were 4,983 crores compared to 4,798 crores in the first quarter and 2,777 crores in the second quarter last year. I request you to refer to slide 49 for some of the details. Of the total gross slippages, as you can see on the slide, the corporate segment slippages were 2,862 crores. I'm referring to the chart on the bottom left. Of the 2,862 crores corporate slippages, 97% came from loans and investment exposures to clients rated BB and below at the end of the previous quarter. Net slippages in the quarter were 2,770 crores compared to 2,621 crores in the first quarter and 591 crores in the second quarter last year. Of these net slippages, 1,806 crores came from corporate, 468 crores came from SME, and 496 crores came from retail and agriculture segments. Let's now turn to slide 50 for a look at the bank's BB and below book. As you can see here, the bank's BB and below book reduced from 7,504 crores at the end of Q1 to 6,291 crores at the end of Q2. The bank also has a non-fund-based outstanding of roughly 2,200 crores to these BB clients and an investment exposure of roughly 1,750 crores to them. As you can see on the chart, the funded BB and below outstanding has reduced during the quarter to 1.1% of overall loans. If you flip to the next slide, slide 51, you will see that this is 3.4% of the bank's corporate loan book, down from a peak of 12.6%. We are now close to the range in which we saw the BB portfolio during more benign periods in our history, though clearly there is still a small gap for us to cover. Moving beyond corporate lending, I'd also like to spend a minute highlight some facts about the retail asset quality. Asset quality ratios in retail continue to be modest. Net NPA ratios in retail remain around the 0.6% mark, similar to where they have been through most of the last 2 years. Moving on to provisions, I request you to refer to slide 55. Specific loan loss provisions for the second quarter were 2,701 crores compared to 2,686 crores in the second quarter last year and 2,886 crores in the first quarter of FY20. Including provisions for standard assets and other provisions, total provisions were 3,518 crores. These other provisions include 535 crores towards the ongoing provision for land assets, which we have spoken about in prior quarters. You might recall that the book value hit of this land asset provisioning has already been taken by the bank in its entirety in the fourth quarter of FY19. The bank's provision coverage on non-performing assets stands at 79%. compared to 73% at the end of second quarter last year and 78% at the end of the first quarter this year. The bank currently holds additional provisions of around 2,600 crores towards various contingencies, up from 2,358 crores at the end of June. This is over and above the NPA provisioning included in our PCR calculations and the 0.4% standard asset provisioning requirement on regular assets. Please refer to slide 52 in the presentation. This is a new chart that we have added this time, where you will see that the bank has been recovering about 10% on an annualized basis from the prudentially written off pool. We currently have a stock of rupees 23,089 crores in the prudentially written off portfolio. SMA2 levels at the bank are currently under 0.5% of loans. If you move to slide 54, this is our regular slide where you see the credit cost trajectory of the bank over the last multiple quarters. Credit cost for H1 stood at 1.95% on a gross basis and 1.77% on a net basis. The gross compares to 2.24% in the H1 of last year. As we look forward to Q2, a quick comment that over the last 6 odd years, the bank has consistently witnessed credit costs in the second half to be lower than the first half. Our H2 should be seen in that context. An important monitorable in this regard, however, would be recovery from large cases that have been in the IBC process for a while. Over the medium term, we continue to expect our credit costs to be below our long-term average. Let's move now to theme number 2, the bank's strong operating performance, which is visible across almost all revenue and cost line items. I request you to refer to the section starting slide number 10 in the earnings presentation. Operating profits grew 45% year-on-year with contributions from all revenue and cost lines. This is driven in part by a strong quarter on treasury income. However, even if we exclude those treasury gains, the core operating profit grew 30% year-on-year. Profit before taxes for the second quarter was 2,433 crores, up by 109% year-on-year. During the quarter, we saw a reduction in the corporate tax rate from 34.94% to 25.17%. This reduction is likely to have a strong positive impact on the bank's profitability as we go forward. However, in the quarter of transition, it does introduce a large one-time tax provision as we restate the deferred tax assets held on the bank's balance sheet at the previously higher tax rate. In the second quarter, the bank has recognized a one-time tax provision of 2,138 crores in this regard, and with that we have fully incorporated the historical DTA restatement required under the new tax structure. With this incremental tax provision, the bank's net loss for the quarter was 112 crores. If we exclude the impact of this DTA-related tax provision, adjusted net profit of the bank would have been 2,026 crores, a growth of 157% over the second quarter last year. NII for the quarter was 6,102 crores, a growth of 17% YOY. I request you to refer to slide number 15 in this regard. As you can see here, net interest margin for the quarter improved by 11 basis points QOQ and stood at 3.51%. This compares to a NIM of 3.36% in the second quarter last year and 3.40% in the first quarter of this year. Domestic NIM was up at 3.63%. The bank has introduced new floating rate loans linked to RBI policy repo rate for retail customers and micro and small enterprises with effect from the 1st of October 2019. At this point, it is too early to predict the rate and customer behavior impact of this on the industry. During the transition phase, one can expect some margin volatility on this part of the portfolio. However, through the interest rate cycle, we do not expect significant change. We also expect banks to innovate on product design, both on the asset side and on the liability side, to manage balance sheet impacts. At the beginning of the year, we had indicated that we expect net interest margin for FY20 to remain broadly flat compared to last year with an upward bias. With our H1 performance behind us, and given our current liability and capital structure, we believe that the upward bias scenario is more likely to play out. We now expect that our NIM for FY20 is likely to be higher than our NIM in FY19. Non-interest income for the second quarter grew by 45% year-on-year to 3,896 crores. This comprises fee income and trading profit. Fee income grew 11% year-on-year to 2,649 crores. This growth was led by a 16% growth in retail fee income. Within retail, fees from our cards business grew strongly at 21% year-on-year. The cards business now constitutes 26% of total bank-level fees in this quarter. Corporate credit-related fees grew by 13% year-on-year in the second quarter. Trading profits stood at 809 crores during the quarter, primarily driven by gains booked in our GSEC portfolio. Miscellaneous income for the second quarter stood at 438 crores, largely comprising recovery from written-off accounts. Operating expense growth continues to be an area of strength. OPEX growth for the quarter stood at 6% YOY. Cost to assets continues to reduce and stood at 2.06% as of the first half, as compared to 2.13% at the end of FY19. We intend to continue improving our cost efficiency and build cost consciousness across the bank. However, given our branch opening plans, investments we continue to make in areas like digital, and the steep improvement in the cost to assets metric in the last few quarters, we expect this metric to now consolidate around current levels before trending towards our medium-term goal of 2.0%. Let me move now to theme number 3, growth, starting with deposit growth. Please refer to slide 6 in the presentation. There's been a tough quarter, or a tough period in general for deposits, with deposit growth sectorally being around 10%. In this environment, the deposit performance of the Axis franchise has remained very strong. As you can see on slide number 6, on a quarterly average basis, CASA and retail term deposits together grew 21% year-on-year. Within this, SA grew 10%, SA grew 6%, and retail term deposits grew by 36% year-on-year on a quarterly average basis. CASA and RTD together form 79% of total deposits. Amitabh mentioned this earlier. In spite of the tough market conditions and deposits, we do believe that we need to strive to improve our CASA growth, and our teams are working hard towards that goal. Slide 23 highlights the strong growth of our wealth management business, Burgundy. We manage one of the largest wealth management businesses in the country, with AUM of 1.4 trillion rupees as of the end of September 2019. Let me now discuss loan growth and the trends we are seeing across our key business segments. Our loan book grew by 24,318 crores in this quarter, the highest QOQ growth in the last 8 quarters. Domestic loan growth for the quarter was 19% year-on-year. International loans degrew by 25%. Retail continues to be the key growth driver, growing at 23% YOY. The bank's strategy on retail assets continues to be centered around existing customers of the bank. 85% of retail asset originations in the second quarter were from existing customers, 93% of the bank's credit cards, and 88% of personal loan originations in the quarter were from existing customers of the bank. SME loan growth was tepid at 2% YOY. As indicated by Amitabh earlier, we remain a bit cautious on the SME space right now, and that reflects in our growth numbers. Term loans and working capital loans grew at 4% and 1% YOY here respectively. 79% of SME loan book is working capital. 86% of the non-NPA outstanding here is to clients rated SME 3 or better. In the corporate book, domestic loan growth stood at 18% and the international book degrew by 32% YOY. Let's move now to theme number 4, digital and payments, where our strengths and leadership position continue. Let's start with slide 31 on credit cards. The bank has nearly 6.6 million credit cards in force at the end of the second quarter, making us the 4th largest credit card issuer in the country. In the second quarter, over 55,000 crores of card spends went through the Axis Bank network across our issuing and acquiring businesses. We launched our premium credit card offering, Magnus, during this quarter. Slide 34 highlights the rising contribution of digital channels to business growth. As you can see, 58% of all savings accounts opened in the second quarter were through tab banking, and 43% of personal loan disbursements in the second quarter were through digital channels. Slide 35 highlights our strong position in the UPI, or Unified Payments Interface, space. During this quarter, we saw 320 million UPI transactions, with total transaction value growing over 3x YOY to rupees 39,340 crores. We have a registered VPA base of over 56 million and a market share of 12% in terms of transaction volumes through UPI for the quarter. During Q2, Axis Bank customers undertook transactions worth 1.36 trillion rupees on the Axis Bank mobile app, a YOY growth of 60% in transaction value. The Axis Bank mobile app continues to feature among the highest ranked banking apps with a user rating of 4.7 on Google Play Store and 4.6 on Apple Store. Moving on to theme number 5, the bank's capital position. Please refer to slide number 57 in the presentation. The bank's CET1 ratio at the end of Q2, including profits for the first half, was 14.04%, with a Tier 1 capital adequacy ratio of 15.25%. CET1 ratio increased by 236 basis points during the quarter and 277 basis points during the half year. Equity capital raise of 12,500 crores during the quarter helped boost the capital adequacy by 225 basis points. Regulatory changes in the second quarter pertaining to lowering of risk weights in personal loans drove a further 26 basis points of CET1 benefit. Book value per share as of 30th September 2019 increased to 298 rupees from 272 rupees as on 30th June. The increase was primarily on account of the bank's capital raise during the quarter. Additionally, 535 crores of other provisions that we spoke about relating to land parcels further got released, and we provided the same through P&L. A very quick look now at our subsidiaries. Axis Finance, our NBFC business, now has a loan book of 7,360 crores. The business continues to deliver great returns with an ROE of 12.8% and a net interest margin of 4.9% for the second quarter. The gross NPA ratio of the business stands at 0.4%. Axis Capital, the institutional equities and investment banking franchise of the bank, has been the leader in equity and equity-linked deals over the past decade. During the quarter, Axis Capital executed 6 transactions. Axis AMC, our mutual fund business, continues to perform very well, with a 20% YOY growth in average AUM over $1 trillion rupees for the second quarter of FY20, led by 33% YOY rise in the number of client folios. Equity and hybrid businesses comprise 57% of this AUM. InvoiceMart, the bank's digital invoice discounting platform, continues to do very well and enjoys a market share of 42% amongst all TRES platforms. We currently have more than 3,500 participants on the platform and have clocked more than 4,800 crores in finance throughput by e-discounting over 3.3 lakh invoices. Freecharge, the quarterly active user base of Freecharge was approximately 11 million at the end of the second quarter. We have started to gain strong traction on our strategy of selling the bank's financial services products on the Freecharge platform to a new base of young digitally native clients. This platform is likely to be an increasingly significant part of the bank's digital strategy going forward. Finally, let me quickly reiterate our outlook for the rest of the year. We expect our loan growth to be 5 to 7% faster than the industry. We expect cost to assets to consolidate around current levels, and over the medium term, we expect to reach cost to assets of 2%. We now expect net interest margin for financial year 20 to be higher than net interest margin in financial year 19. We reiterate our medium-term range of 3.5 to 3.8% on net interest margin. On credit costs, a lot will continue to hinge on large recoveries currently in the IBC pipeline as we look at H2 credit cost numbers. As we close, let me re-summarize the key themes for the quarter. Asset quality metrics largely stable, decline in stress pool, strong operating profit performance, healthy growth metrics across both advances and deposits, continued leadership across digital products, and finally, much stronger capital position in the wake of our recent capital raise. With that, we come to the end of our comments. We'd be glad to take your questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Maruk Adajania from IDFC. Please go ahead.
Yeah, hi. My first question is on your exposure to 8 stress groups. How has that moved during the quarter?
Maruk, thanks for your question. We have stayed away from talking about those 8 stress groups again. What I would emphasize is that of these stress groups, we have seen some significant movement in terms of slippages, etc., and that has come in through from our slippage numbers. Also, the overall exposures have reduced noticeably, though we are not disclosing specific numbers on that sector on those 8 groups this quarter. I'll say that all the groups, all the individual entities there that we are concerned about in terms of their asset quality position are all part of our BB portfolio, either in fund-based, non-fund-based, or investment book.
Okay, and just in terms of the investments associated with double B, so you need to add that figure, right? And what would be the comparable figure last quarter?
Just a little bit more than this. We have disclosed 1,750 crores now, and it was about 2,500 crores last quarter.
Okay, and what was the MTM this quarter on investments?
65 crores.
Okay, got it. Okay, and just one more question on life insurance. Any further discussions with RBI on taking a stake in life insurance companies?
Nothing that we are in a position to disclose at this point, Maruk. We are continuing to have conversations. We'll let you know if there's anything worth talking about.
Okay, thank you.
Thank you. The next question is from the line of Vishal Goyal from UBS Securities. Please go ahead.
Hi, thanks for taking my question. So my question actually is on the margin and cost of fund progression. So we've seen decline in cost of fund in this particular quarter, despite slight increase in cost of deposit, as that's highlighted on your slide 14. So is it because your borrowings, which have declined almost 30-40% sequentially, is that the reason for cost of fund decline?
That is the main reason. Also, the fact borrowings have been refinanced at slightly lower levels than what was held in the book. What fell off for refinance?
Yeah. So, any sense on like what would be cost of borrowing for us versus cost of let's say deposit? It will not be very different. I mean, it will be
No, cost of borrowing will be a little bit higher than cost of deposits, about a percentage point higher.
Okay. And so I think with the capital raise, behind us, I mean, I'm sure, even if you look at your, mathematically, your margins would be higher, right? So should we not expect 20 basis plus kind of improvement in margin YOY? I mean, any reason why they're refraining from, any pointed guidance?
No, I mean, we have said that directionally we expect, I mean, we did change our guidance just now. Instead of saying that we are going to be roughly in the same range as last year, we are now saying that we will be higher than last year. Exactly how much higher, I mean, we can all do the math. Let's let the quarter, next second half play out. Yes, your math is right with the capital position and the overall liability stack right now. Margins should be higher, but we'll also need to see, importantly, how the government and RBI push banks in terms of yields on an ongoing basis. It's not something we want to extend ourselves too much on right away in terms of how much improvement we might expect. Yes, directionally it will be better than where we are at right now.
Sure. And just one last question, if I may ask, especially on asset quality. And I'm sorry, I'll be asking about 8 group because that reference is there in everybody's still mind among investors. So this investment book, which we are now showing both the slippage and the outstanding number, that was part of the 8 groups, right? Like we gave a 20 billion kind of a number last time.
Overlap, yes.
So is it an overlap or that entire amount would be already reflected here?
Almost entirely. It is not exact, but almost entirely. And from that original sort of investment book, some stuff slipped during the course of the quarter. And what is remaining right now is the 1,750 crores that we disclosed.
Right. And also, I think both in your double B and below, there would have been a little bit of repayment as well. But even in the 8 groups, if you give us some broad sense of whatever, percentage also, the repayment, etc. would have happened, that will help us,
I know, but it's a conversation I really don't want to get into.
I think, boss, we have been very, very transparent with our numbers now. Don't beat us up with the transparency so much that you basically want every number out there. I think basically the message is the stock is coming down. All of it is broadly captured. We have given you as much details as we can and are comfortable with. And the overall exposure to these so-called 8 groups is also coming down.
Okay, sir. All the best.
Thank you. Thank you.
Thank you. The next question is from the line of Kunal Shah from Edelweiss. Please go ahead.
Yeah. So just in terms of the moment in the double B and below, how would that have been maybe in terms of the upgrades, downgrades, and the slippage? So slippage is more or less known in terms of the corporate. We have highlighted how much is coming from the loan book. But any upgrades and downgrades within the double B and below book?
Sure. We added on a fund-based basis, let me just do that math, and the rest of the math is actually not, the rest of the numbers haven't moved very much. It's the funded book that has moved a lot. 1,100 crores roughly of additions, roughly 1,700 crores of slippages, and the rest is balance movement.
How much of the upgrade? 100 crores?
Balance movement. No, balance movement. I didn't talk about upgrade separately. I'm saying slippage into NPA was about 1,600 crores.
Yeah.
Yeah, 1,600 crores and 1,100 crores of addition. So 1,100 crores got added, 1,600 crores went away, and the rest was balance reduction in existing accounts.
Got it. Perfect. And secondly, in terms of the arrangement with Bajaj for, say, this entire life insurance tie-up, so how different would it be as compared to that of the arrangement which is there with Max at this point?
Well, it's the beginning of a relationship. Let's see how that progresses. We will get to learn and know each other and how to work well with each other. Over time, we will get to see how much the business progresses, etc. We'll keep you informed. Right now, there's not much to talk about that.
But any key differentiation in the arrangement between Max and Bajaj at this point?
We are not disclosing terms, etc. man.
Okay, no issues. Yeah, thanks a lot.
Thank you.
Thank you. The next question is from the line of Krishnan ASV from SBI Cap Securities. Please go ahead.
Thanks. So my question is to do with how you're reconfiguring your book, especially on the loan side. Just in terms of the mix between SME and retail, there is a certain element of narrative that the mid-corporate segment, the SME segment, you have become extremely cautious in terms of shedding even what marginal business which would have been non-GST compliant, etc., and tighter controls in place in the SME space and far higher risk appetite on the retail space. So just wanted to understand what kind of changes have you made to the SME book, purely in terms of your controls.
So the way Krishnan I frame this is go back to what Amitabh and I have been talking about for the last 2 or 3 quarters, which is not being fussed about a particular target end state in terms of what the book mix needs to be, but rather be opportunistic in terms of where the best or highest RAROC opportunities lie in any given quarter. As it happens, right now, the best risk-adjusted return is not available in SME. Either the risks are a little bit more uncertain than what we are comfortable with, or we are not able to get the kind of rates that we would need to do that business. So the last couple of quarters, we have seen us go slow on that business. But there is no great sort of grand design here in terms of where we want to go. If tomorrow the risk-adjusted return metric moves, or our expectation moves, then that we are perfectly happy to go do that as well. So don't think of this as part of a grand strategy, but rather sort of tactical choices being made on a quarter-to-quarter basis.
Right. And just on the retail bit, I mean, there has been a fair amount of acceleration that we have seen this quarter, especially in light of how the rest of the book has moved. I think the 23% growth in retail.
Yeah. If you see our retail book, I mean, it has roughly been growing at this level for a long time. Actually, if you see one of our slides, slide 21, you will see that over the last 6 years, we have grown the retail book consistently at about 25% CAGR. So there is nothing sort of particularly different about this quarter. We have been growing at 20+% very, very consistently for long periods of time, and we continue to see retail as a space in which demand continues to be stronger than supply, and you will continue to see us participate. As I said, if at any point of time in any given product we find that the risk-adjusted return expectation is worsening, you will see us go a little bit slow on that. Whether it is, let's say, in today's environment, maybe something like commercial vehicles or something like that. But in general, we are quite happy with the businesses we are in.
Right. So my only point was, given the shape of growth in the various businesses, is it fair to assume that you are seeing opportunities for comfortable risk-based pricing in retail? Because that seems to be one of okay.
No, absolutely right. Yeah.
Thank you.
Thank you. The next question is from the line of Adarsh Parasrampuria from Nomura. Please go ahead.
Hi, Amitabh Jaram. Question on, again, retail growth. One, mortgages growth has kind of picked up in the last few quarters for us. So is there any buyouts or this is organic self-origination?
All organic, Adarsh.
Okay. And in autos, while I agree that the market share would be low in respective segments, OEM numbers have been down pretty significantly. System growth's been coming off sharply. In that context, can you explain market share gains product-wise in terms of what's happening on the auto loan side?
A couple of things to note. One is that our auto business continues to be focused, like most of our retail lending businesses, on internal deposit customers of the bank. So we are continuing to see sort of a decent penetration in all our branches. We are able to sell quite well. That's point number one. Point number two is starting point in terms of how large our market share is. As you rightly mentioned, our market share was low to begin with, so growth continues to be robust there. Number three is the used car business, where we have done some good work, and we didn't have a used car business a few years ago, and now we are starting to build some capabilities there and getting to about 10% contribution from that in our incremental business. So that's that's helping as well. Also, because our existing book size is small, and let's call it the incumbency effect or the lack of incumbency effect, because our existing book is not that large. In absolute rupee crore terms, the runoff we see is actually not is not that large, and so from a disbursement basis, the largest player in the market might have 30+% of incremental disbursements, but still their book size in auto might not grow. But for us, with 15% of the market disbursements, our book size will grow quite a bit. That is the math that you're seeing in play.
Understood.
Also, as a small aside, we have also started some of the other businesses related to the wheels side, example, two-wheelers. We have started to do some of those businesses as well, and you'll hear more about it in the quarters to come.
And one small clarification, when you were mentioning about your BB and below book and, the overlap with that top 8 accounts, you did make a statement that whatever one could consider to be stressed or difficult in terms of, the progression of those accounts is broadly reflecting in the BB and below book. Is that understanding of that statement clear? What I mean is...
Absolutely. Not broadly, entirely. Everything at the account level, all the accounts within those 8 groups or any other groups that we thought are problematic are all part of our BB book, either in the funded, non-funded, or investment portfolio.
So how should one look at it, right? When I look at the pool of problem accounts in the last quarter, and when I just take the top 8 exposures that you gave, and with all the net offs that you provided, and now when I look at the book with the slippages, it seems to be a large drop, which means there are some accounts where versus last quarter you feel more comfortable now, or how should one read into those? And I wanted to specifics. One would be a funded media exposure, the other would be a non-funded telecom exposure. So this would be the 2 large elements there. So I just want to understand how should one look, because it's a material drop if one considers that any name which one considers stressful is already accounted for in the BB and below pool.
The 2 comments I'd make. One is that there is a significant amount of slippages that have happened from those 8 groups, which happened in the second quarter. So those 8 groups overall, the total exposure there, kind of advances, non-funded investments, etc., have come down something like 25%, because a lot of slippages has actually happened there into NPA. So not much is left. The second piece that I say is the 2 specific situations that you mentioned. Those 2 situations, nothing much has changed in them in the second quarter.
Understood. Perfect. Yeah. Thanks a lot.
Thanks, Adarsh.
Thank you. The next question is from the line of Neelam Mehta from HSBC Global Asset Management. Please go ahead.
Yeah. Hi. Thanks for taking my question. Just wanted to get some sense on the credit cost guidance which you have been giving. If I recollect, the expectations earlier were that by second half we should be normalizing to our long-term averages. But Jairam, in your comment you have said that that's the expectation, but you can't guide for this year. So is our credit cost guidance getting pushed, normalization getting pushed back?
Not offered any credit cost guidance for this on an annual basis at all. We have only been talking about credit cost over the medium term, which we defined as FY22.
What would be this medium term? Because this medium term is going on for the last few years.
FY22. We've been very precise on that.
It's not been going on forever. I do want to correct you here. When we announced in January, we said 22 it will be below 1%. So please don't say that we've been going on for a long period of time. So very, very specifically we are given it.
So you're saying by
if you're asking a specific question, I want to register that with you. Please don't say that we are being very casual about what we are saying.
And in general, the short term, for the short term or on an annual basis, we have not offered a credit cost guidance for FY20. The only thing that I'll sort of point out is what is there on slide 54, which is that in the first half of last year, the credit cost was roughly 225 basis points. In the first half of this year, credit cost is about 195 basis points. I'll sort of leave it there and not go any further in terms of offering specific guidance for this year.
Sure. And in terms of key HR changes while the team is in place, is there been any changes in the one-downs below that which are relevant to be known to the market?
Well, we'll let the market know whenever those changes are happening. I mean, if we believe we are ready and we need to announce some of those changes, we'll be the first ones to let you know. Because we have not made any announcement, that means that this is not the right time to talk about them. But I think, as I said in the opening remarks, that almost all the management team members at N-1 and N-2 levels are in their positions, and hopefully you will see stability from here on. There are one or two positions where we might make some additions. There are one or two positions where we might have to make some changes, but that's part of any normalcy which you see happen in any large institution of this kind. For example, we have added a very senior resource in Access Finance. We keep adding people here and there depending on where the requirement is.
Sure. And then last question is on group on NBFC exposure. So some of the NBFCs which are currently in stress in public domain, do we have included them in the stress BB kind of a pool because they are rated, public ratings are pretty high right now. So if we have exposures to them, have you already included them in our stress group?
Let me put it this way. There are some NBFC exposures. There are some NBFC exposures in our investment book which are in our BB portfolio. So that does include. I'm not sure all the names you might be thinking of, but I can certainly confirm that there are some NBFC exposures in our
currently.
Market
is being worried about some NBFCs which try to merge with a bank. So our exposure to them would be in the BB book, or?
I can't talk specific, account level stuff, Nilan.
Okay, no, because just wanted to get comfort because when management is saying that they have looked at all the stress and disclosed it, so just wanted to understand how conservative are we in this assessment.
Yeah, so we have tried our best to be as realistic as possible in terms of looking forward for where slippages might come from, and we'll keep updating it as we get kind of newer and fresher information. Remember, the BB is a live book. Every quarter, you see an update to this book, and as conditions keep sort of moving up and down, as we saw with us last quarter, we thought the environment was getting worse, so we increased our BB book and downgraded a lot of accounts. This quarter, we downgraded a little bit, but not as much. So we'll keep doing that based on how the environment progresses.
Okay. Thank you so much.
Thank you, Nilan.
Thank you. The next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. A few clarifications, sir. One is this 26 billion of outstanding contingent provision. This would include the land-related provisioning, or this is separate?
No, the land-related provision is not part of this.
Sure. And the second, sir, is this 11 billion of addition to BB and below. This is comparable with 22 billion that we did last quarter, right?
Correct.
Sure. And, sir, secondly, if you can provide the NFP outstanding to already NP account. I believe it was some 2,800 crores last quarter.
It is 2,500 crores now.
25?
Yes.
Sure, sir. And and one more thing, sir, this media and entertainment, now it has gone out of top 4 sectoral exposure in BB and below. Does it mean that it has actually gone out of stress or for either for slippages or recovery, or is it just that it does not figure in the top 4?
There is also slippages as a third possibility.
Yeah.
Okay.
I'm not saying anymore.
Okay, and so just last, a small clarification. We have this 2,600 of contingent provision. Could we not have utilized this in this quarter? Or, I mean, is there something which stops us from utilizing this contingent provisioning? And so, I mean, we have, of course, have taken a call that not to use this contingent provision and showing a net loss. But I'm just trying to understand, was there any sort of compulsion in utilizing that thing?
No compulsion, just internal policy stance. We want to be fairly predictable and formulaic about how we do some of these provisions for various contingencies, and don't want to, on an ad hoc basis, depending on need in any given quarter, sort of use it or create it. So we have tried to be as formulaic as possible in that, and if that means that we don't have a ton of flexibility in actually using it in a particular quarter just to get over optical sort of flat issues or whatever, so be it. We are perfectly comfortable with it.
Sure, sir. Thanks so much.
Thank you.
Thank you. The next question is from the line of Bhavik Dave from Nippon India Mutual Fund. Please go ahead.
Hi, sir. Sir, my question is regarding your retail term deposits, which have been growing quite well over the last couple of last 3-4 quarters, and we've been talking about it. Just wanted to understand, are we getting new customers, or are the existing savings account customers being converted into term deposit customers?
There's a little bit of both in any large bank with a very large network. When the entire network starts working on selling a product like FD, you can't be super precise about saying, target this person but not that other person. So you will see some internal customers whose money might have been lying in SA, for example, that gets converted into FD, at least in part. But there is a lot of new customer acquisition, particularly from PSU banks as well, where price sensitivity on the FD side is quite high, and giving us giving good rates, about 50 basis points higher than PSU banks, gets us there. Rajiv, you want something to add?
Yeah, so there's one more nuance. There is money coming from existing customers, money coming from new customers, and also money coming from existing customers who move money from some other bank into this account and then convert it into an FD as well. And we see that happening quite a lot, where money is moved from let's say a public sector bank, stays in our savings account for a few days, and then converts into an FD as well.
Right. And my second question is regarding your insurance tie-up that we've done recently. Does this, and we're incrementally added a new large player, so does this mean that our ambition of increasing stake in one of the existing players has been shot down by RBI, or we're just expanding or increasing our revenue pool from via Bajaj Finserv?
The latter.
Okay. So the first one remains as is, right? We're still in conversation with the RBI, and as and when things improve, we'll get into it.
Yes, as and when we have anything to say on that matter, we'll make a public declaration on it. Right now, there's nothing to talk about.
All right. Thank you, sir. Thank you.
Thank you.
Thank you. We'll take one last question from the line of Roshan Chutke from ICICI Prudential Asset Management. Please go ahead.
Yeah, thanks so much for taking the question. I just wanted to understand the movement in the BB and below book. Hello, am I audible?
Yes, we can hear you. Movement of the double B book, yes.
Movement in double B and below book. So we have about 19-17 crores of slippages from the BB and below book, right? Now, what is the upgrade from below, and what is the negative flow and positive flow into the BB and below book is what I am trying to understand.
We have disclosed all that we want to disclose on this matter. Take the total slippages in the corporate book, 97% of that has come from double B and below clients between fund-based, non-fund-based, and investments. So that gives you a number of how much slippages came from double B and below. You know where we started, and as I mentioned, we have downgraded about 1,100 crores on a funded basis to double B and below. The rest of your math should broadly work out. It's a fairly simple story that downgrades have been lower, much lower compared to last quarter, more like normalized levels. Downgrade to double B have been closer to normalized levels, about 1,000 crores a quarter is what sort of we would deem as normal. That's what happened in this quarter. The entire delta that you see, the reduction that you see across funded, non-funded, and investments, all the delta is because the downgrade is smaller than the slippages into NPA, and a little bit of upgrades have happened out of double B as well.
Okay, just one more question. Last quarter, you mentioned the total potential stress book to be about 20,000 crores, right, including the 8 stressed accounts. What does that number look like now?
We didn't disclose any such number. We gave all the component numbers exactly as we've given in this quarter. I don't know which ones you're adding to get to 20,000. I think you can just add those same numbers for this quarter's disclosures and come to whatever number it comes to. We'll reiterate that for the corporate book, the key portfolio to watch is BB and below, funded, non-funded, and investments. We have given all three numbers on a single slide. So essentially, if you just look at that slide, slide number 50, that should give you all that you need to know in terms of what we are talking about in terms of key people to watch within our corporate book.
Sure. And is there any MSME dispensation you have taken this time around?
Oh, no.
Thank you so much. That's all from my side.
Thank you.
Thank you, ladies and gentlemen. That was the last question for today. I now hand the conference over to Mr. Jairam Sridharan for closing comments.
Thank you very much, Margaret. Thank you very much, everybody, for participating actively in this call. And we wish you a good evening and a very happy Diwali. Thank you.